Hello and welcome. Today we're working on the idea, are stocks really safer than bonds or cash? Sounds crazy, but watch. So let's get started. My name's Jeff from Finally Learn, where I help you finally learn financial skills. Now, there was a series of tweets the other day from Brian Feroldi that talked about things you need to learn as an investor. Number 5 was what's risky in the short term is safe in the long term. What's safe in the short term is risky in the long term. And so I blew up his graphic here. I really like the way he put this. I hadn't really thought of it this way, and I understood it, but when I was younger, this seemed crazy. So this is one of the things that you really do need to learn. So I think this is fantastic. Let's think about what we know. Stocks, we know, are risky, and they go up and down every day, every year, big returns, negative returns, you can lose money. Bonds are less volatile, and cash, so things like savings account, money market accounts, treasury bills, things like that would be cash. Bonds would be treasury bonds and corporate bonds. Stocks are stocks owning a part of a company. Well, over a long period of time, we're talking about 10, 20, 30 years, cash becomes more risky, bonds, and then stocks have the less risk of all. And so somebody asked on Twitter, said, what about this? I don't understand this. So I tried to give a response, and they're not sure, but I thought, hey, I can create a video on this. I can explain this. So let's get started with this idea. So let's talk about investing. Investing, you're putting money in now, which we're going to call purchasing power. This is a Warren Buffett definition. You're transferring purchasing power now with a reasonable expectation of receiving more purchasing power after tax in the future. So that's what we need. We need to have our money grow where we can pay tax on that growth and still have more purchasing power. So that's important. Now, one of the things we need to talk about is there is inflation. We have to assume inflation. So inflation is a reduction in the purchasing power of money caused by a rapid increase in the money supply. Even a steady increase in money supply means our dollars are less valuable. So two people I want to point you to is one is Thomas Sowell, Politicians Steal Your Money Through Inflation. There's a great article there. And Milton Friedman, Inflation is the one form of taxation that can be imposed without legislation. All the government has to do is increase the money supply, print more money, and all our dollars become less valuable. Now, this is not a knock on the United States. Every country, always in history, has increased the money supply, has inflated their currency. That's going to happen. We know this, so we need to be prepared for this. So what does that mean if we have inflation? Money is worth more today than in the future. You cannot hold $100 and just hold on to it, and in 10 years it's worth the same. It's going to be worth less. You know it's worth more today than it will be in the future. Anytime you have more of anything, it's worth less. So here's our current inflation in the United States is 9.1%, similar around the world, but here's what it is in the United States. That means at the beginning of the year, if you had $100, you need about $109 at the end of the year to buy the same amount of goods and services. We know some things are more than 9% increase. Gasoline, for example, is more. Some beef is more. Some things may be a little bit less, but as a general rule, our money has have inflation of 9.1%. All right, so let's test our little assumption that we're making. I pulled information from Professor Damodaran, and it has historical returns on the stock market, on treasury bills, treasury bonds, and inflation. You can't see this, but I'll give you a link below here. So here is, I pulled it down on an Excel spreadsheet here. So it goes from 1928 to the end of the year 2021. So what happened was in 2021, the inflation rate was 7%. There was a 28% return on the S&P 500. So let's talk about what we have here. The S&P 500 is the largest 500 U.S. companies. So they're big, huge multinational companies. And so that's going to represent stocks for us. We have treasury bonds, 10-year treasury bonds for the United States. So we'll call those just bonds. And then treasury bills, here are the bills. They're 90-day treasury bills that are short-term money. So that's like cash, like a savings account, so on. So here's the returns. We have the returns all those years. So what I did, let's calculate all those returns, and then we have inflation. So the way we do this is we start with, let me show you how the math works. I built this spreadsheet. I can give you other spreadsheets if you want to care about how the Excel works. But let me show you real quickly on this because I'm trying to just make the point that stocks in the long run are safer than cash or bonds. So what happens is we need to take the 1,000 initial investment times, and I'm going to grow it by whatever that return was in the very first year. That number, and I need to do 1 plus the return, so 1 plus that 43%, so that 1,000 would grow like $438. So big return in 1928, and then you see we have some big losses in the 1930s. So we have some big losses, 1930, 1931. All right, so in the short term, stocks are way, way, way more risky. So then we just ran that out. We did all the years and had a return. So if we go to the very bottom here, if you invested $1,000 in the S&P 500, you would have $7.6 million. If you invested in bonds, you'd have $85,000. If you invested in bills, which is cash, about $20,800. But inflation would be $16,000. So let's see how we can interpret this. $1,000 in 1928 is worth like $16,000 in 2021. So if you watch an old movie or read a story, let's say somebody has $1,000 in 1928, you think, oh, okay, $1,000, I know what $1,000 is. $1,000 then is like the purchasing power of $16,000 today. In other words, you'd have to have $16,000 in 2021 to equal the purchasing power you'd have in 1928 with $1,000. So if your money doesn't keep up with that inflation rate, you're losing purchasing power. So let's look at what we have. So I just grabbed and put the future value over. And this is a long period of time, 94 years. So what happens is $1,000 turns out to be $16,000 with inflation. If you put your money in Treasury bills because you're so worried about losing money, here's what happens. Let's look at the 5 worst years. You never lost money. Good job, you never lost money. The problem is you've got $20,000 before you pay tax. Let's assume tax is 25%. You'd have $15,000 after tax, and you have lost purchasing power. So bonds are a little bit better. Bonds, you would have, let's say, 25% tax. You're down to $65,000 maybe, and so $65,000, you've just barely increased your purchasing power over time. You have lost money a few of those years, but you have not really increased over a long period of time. You haven't really increased your purchasing power very much. Stocks, on the other hand, you've increased your purchasing power from 1,000 to 7.6 million. Even if your dollars are worth less, 7.6 million is a huge increase in purchasing power. So let's think about this in terms of our annual growth. So this is CAGR, which is our compounded annual growth rate. Our 94-year rate of inflation is about 3%, which is relatively low, but over time we lose purchasing power. Our Treasury bills barely beat inflation, but after tax they're behind inflation. So if you invested in Treasury bills, you're behind after tax because of purchasing power. So it's basically a negative return. Bonds, you're just ahead of it a little bit. You have a little bit higher return. Stocks, you have around a 10% return over that 94-year period. Our total return is massive. The way we do the total return is you take the $7 million divided by the original 1,000, subtract out the original investment of the 1,000. So you've got 761,000%. You've got 1,500% of inflation. So you have to beat that. Now here's what people are so worried about. The idea of standard deviation or the risk, and let's look at it, the 5 worst years. If you invested over 94 years, which It would be really difficult for somebody to do. But over 94 years, your worst year is negative 40, almost 44%. And then number 2 is negative 36.5%. That was in 2008. I remember that year. And we survived it, and we kept going. We still, over that long period of time, got a 10% return. So you might say, hey, look, I'm not going to invest over 94 years, but what about 40 years? So let's look at the last 40 years, the same kind of thing. I've rolled up a $1,000 investment and calculated it for 40 years from 1982 to 2021. So a $1,000 investment grew to $100,000 to $17,000 for bills, $4,000 for bonds, $4,000 for cash, and then inflation is almost $3,000. So let's look at what we have. So your inflation rate the last 40 years has been pretty low, 2.75. Your stocks have had a good run, 12%. Your total returns, you have these negative returns that are so scary. But what happens is, if you had $1,000 in 1982, you need $3,000 in 2021 to have the same purchasing power. Now, this has been in my lifetime. I can see this. When you get older, you see this, but when you're young, this is kind of mind-blowing. So bills is basically cash. This is a cash investment. Then after tax, you're right there with inflation. Bonds a little bit better, but you have 1,000 became 100,000. That's fantastic. Over a long period of time, stocks are going to beat bonds and bills, and they're a more safe investment. All right, so let's keep going. So if we think about it another way, and I just did the math, we did 3%, we did 2.75. Over 94 years, $1,000 needs to be $16,000. So we've lost 93% or 94% of our purchasing power of a single dollar. This is a scary thing to think about, right? Over a long period of time, you're going to lose purchasing power of your dollar. Now, how do we calculate this? We're going to calculate this as, I want to take the 1,000 divided by the 16,000. So each dollar is worth about 6 cents. $100 is worth about $6. So you lose purchasing power over the 40 years. The 1,000 that needs to be about 3,000, you've lost about 2/3 of the value. You lost 66% of the value of your dollars. Dollars in 1981 were worth more than dollars in 2021. Okay, that's another way to think about it and see. So let's look at we have the U.S. inflation calculator. So I've got a link to this. So let's look at 1982 to 2021. Let's do $1,000. Now these numbers may not be exactly the same. We might have different numbers here, but 1,000 would be 2,800, and the cumulative rate of inflation is 180%. So dollars are worth more earlier than they are later. They're worth more now than they will be in the future. That's what we need to take from it. Let's keep going. Couple of things, couple of quotes from Warren Buffett to understand this. Stock prices are always more volatile than cash equivalent holdings, so bonds and cash or bills or whatever. Over the long term, these currency denominated instruments, the ones that are just in dollars, are riskier, far riskier investments than a widely diversified stock portfolio that are bought over time and that are owned with really small fees and commissions. Here's the conclusion. It's unconventional but inescapable conclusion is for the past 50 years, we did 40, so 50 would be fine. It's been far safer to invest in a diversified collection of American businesses, that's stocks, than to invest in securities, treasuries, and treasury bills, treasury bonds that have been tied to the American currency. So what do? Well, this means that you can buy and hold like an S&P 500 index fund. Here's some, find one that's a low cost, buy every month, hold over a long period of time, and you'll be much better off than if you held cash securities or bonds. So here's a couple here. Thanks for watching. We'll see you on the next video.